We talked before we came here, or at least as we were walking in, talking about what is the biggest thing we should start with, and you actually said the dollar and all the leverage and the asset-based kind of pinup that we have here. And so I give you the first volley with that.
Yeah, I think part of the effect of quantitative easing has been this great radiation of dollar assets into the rest of the world, and it's come in a variety of forms. Some of it's sitting in official reserves. You have about, I think, $11.5 trillion of reserves sitting out there. Some of it's come in the form of dollar holdings by the private sector. Other has come in the form of big public pension funds having turned to the U.S. corporate bond market as their kind of default mechanism in terms of reaping some small premium over government rates, which are negative in a lot of places or negligible in many. And the dollar bond market really in the corporate world is probably unique in both size and liquidity. So people who wanted to take the risk of investment grade corporates really were forced into US instruments, and which is why we've had, the issuance is on track again to provide us with a record this year. It's probably, off the top of my head, I think you're looking at something close to $1.5 trillion, maybe even more.
Crazy.
And I've said this for a long time, all bull markets end with surges in supply. Bull markets don't end because people who've been making a lot of money all of a sudden decide, you know what, I'm making too much money. I think I'm going to sell this. Never. It's always, people look at the people making too much money and they say, gee, I could provide some of that and I could make a lot of money also. So it's almost impossible to tell how long it takes to create like the 3 million extra houses that we did between 2004 and 2007 that eventually caved in the US, the sort of mid-range US housing market. But this time around, it looks like even with the central banks and QE and all the fixed income that's been absorbed, the markets are doing a pretty good job of providing what I would say is an extraordinary level of supply. And so to me, that's the big risk, that all these flows into dollars, whether it's liquid instruments or high-end apartments in New York and San Francisco, or all the things that the global investor has turned to in dollar terms. If you start seeing those flows reverse and the dollar sort of chronically weak, you could really have a circumstance that is not dissimilar to like 1968 to 1980, where you had a lot of high-end deflation, a lot of real inflation, and a serious decline in the purchasing power of the dollar, which really undermined the US economy.